Equity markets are entering the new financial year or FY24 on an uncertain note. Globally, stubborn inflation amid rising interest rates and fears of a recession in 2023 are some risks that the markets need to navigate. Back home, El Nino and its impact on the monsoon and thus inflation also needs to be monitored.
Again, the expectations are that CPI inflation from here onwards should head down, but whether that comes down to around 4% trajectory or not by June, July is something that we have to keep a very close eye on. And consequently, point number 3, which is the rate tightening cycle from RBI's perspective, ideally the April rate hike should be the last one on the cards, and beyond that there should be a longish pause.
Market returns in FY24 therefore will be a play against inflation and monetary policies. Analysts say the RBI's terminal interest rates and their impact on credit demand will be another key trigger for the markets. Another second-order impact of inflation, which may also affect equities' performance in FY24, is earnings growth. If interest rates stay higher for a longer period, it may lead to demand destruction globally and domestically, dent margins and push up finance costs. Analysts said earnings outlook may worsen if exports slow down and weakness in the rural economy persists amid El Nino concerns. Globally, dollar liquidity and geopolitical tensions would be key market movers in FY24.
US interest rates and dollar liquidity conditions, especially for emerging market economies, but also for Euro region countries. The second variable will be the rupee movement versus US dollar, because any major depreciation of INR can have adverse relation to USD returns for FPIs. Any geopolitical events, including relations between the West on the one hand and China and Russia on the other hand, any movement or any greater tension with relation to Taiwan can have a major impact on the market because of semiconductor supply chain issues.
Therefore, with inflation being the sole trigger for equities this financial year, pockets such as mass consumption that benefit from cooling inflation may be better off in the current environment. Today, investors will track the 3-day monetary policy meeting of the Reserve Bank of India along with manufacturing and services PMI data.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.